Hi, everyone. My name is Dominique, and we have the rest of the Greenleaf team here with us today to discuss the Midtown Office Park opportunity. We have Dave and Nathan here who are going to be kickstarting this live stream, really discussing the government and medical opportunity here in Chattanooga, as well as various flexible alternative strategies that is offered and featured in this opportunity. So first and foremost, we always like to start and highlight Greenleaf Connect, really what our mission here is today. Our mission really has always been to be direct, informative, and really provide transparency across all of our Greenleaf audiences. Specifically, we're conducting a live stream today, and we'll discuss our new deal launches. We host these every Thursday afternoon or morning in this case, depending on where you are at in the world. And then we also host private Connect events, which are really more closed events to discuss, to do group discussions, live meetings, things of that nature. All right, before we get started, we just like to provide a quick overview of the structure for this morning. We do have the option to change your presentation view. You can click and drag the slider in between your screen to make our presentation or our panelist view bigger or smaller. There's also a Q&A feature located at the bottom of your screen under the reactions button. Feel free to click that and ask any questions that you may have throughout the duration of the presentation, and our team will be sure to answer those. This is a friendly reminder that this live stream is recorded and will be shared with you by the end of the week this week. All right, now that we have our rules of engagement out of the way, again today, folks, we are discussing the Midtown Office Park opportunity. We'll do a review of the capital stack. We do have our 1031 investors on this call as well, and then we'll dive into that question and answer portion. Without further ado, I will pass it over to our hosts, Dave and Nathan. Thanks, everyone.
All right, thank you very much, Dominique. We're excited to talk about this one today. We are doing it a little earlier. We have another private Connect event this afternoon, so we moved up the Midtown conversation. I think Nathan and I were just eager to get talking about it too. So this is a big one for us. This will be the largest square footage deal we've ever bought, right? And I guess most number of buildings in one location. It checks a lot of boxes on Greenleaf growing, and we're really excited about that. And most notably, we're getting this one for $81 a square foot. So that's really the best we've seen in 2 years. I don't know if we've gotten anything at $80 a square foot recently at all.
A long time. And it's a big deal. So you'll hear us mention it probably a half dozen times. So that's one if you guys are keeping count at home.
We need to have a tally on how many times we get excited about $80 a square foot price and the size of the deal.
Two. No, great to be here today to talk about it. Dave and I are eager to talk about this one. Next month will mark the 2-year anniversary that I've been working on this deal. So, I describe it as, a long distance relationship. We've been on again, off again, and now we're back on again. And now we're cruising, towards closing in about a month.
Lots of late night phone calls.
Lots of Friday conversations at about 8:30 while I'm grilling steaks in my house. I'm on the phone, working on this one. So I think all that work is going to pay off because we got a really good deal here. And all that effort, is really going to pay off. And, Dave mentioned it's a large deal, all in cost of about $26 million, $22 million contract price. But if you look at it, there's 10 individual buildings, so you value them around $2 million a piece. That's kind of Greenleaf's old sweet spot, that $2 to $5 million deal range.
Yep.
So what we're doing now is just aggregating them and buying them at once and getting a little bit of scale and setting on some fees to do the transaction.
Yeah. And it is 80% occupied out of the gates. So we have a little bit of value add opportunity here. And we're going to go through what our strategy is for this deal as a whole, really the overall investment thesis that we're working on here at the Midtown office complex.
Right. 80% occupied and still cash flows as is, covers all of our expenses. So great to have that value add upside, but still be able to pay all of our bills, day one and operate the property, as we would if it was stabilized.
Certainly that always makes it exciting when we're going in, if we know we can cover everything and then just add value from there. So on the investment highlight section, I was going to say it again. I guess it'll be the third time this $81 a square foot. So Nathan will give me extra points there, but you want to walk us through just kind of what we're thinking here overall?
Sure. This is a great page. Shout out to Dominique for putting it together. If this was Dave or I, it would just be a blank white paper with 5 bullet points. That shows you kind of how we've come on that perspective, marketing wise. But this is the crux of the whole deal. These are the 5 points we want everyone to leave today knowing. And as you can guess, number one is that low basis, the $81 a square foot for an occupied, good looking building. Check out the picture on the left side of the page. And that compares to, some comps in the area that range from $100 a square foot all the way up to $200. So that's a really good basis, which is, I think a pillar of Greenleaf's investment strategy is, find these deals, get them at a good basis, and then just add value. And we also just got our appraisal back that, came back $600,000 higher than what we're under contract for. So as is value day one, I think we already have some value created. And then number two, after we close and start operating the property, we've got 2 strategies we can go after to add value to the deal. What we're calling the sum of parts are greater than the whole strategy, which we'll go into detail later. And then in-place rents for this property, trail a submarket by 25%, and with some leases 50%. So there's a lot of opportunity to come in and upgrade the space and push these rents closer to submarket.
Yeah, we've talked about that on many of our Greenleaf deals where we're going to go in and try and add operational value, which is done through renewals, tenant relationships, and improving the existing space. Not necessarily doing full-scale renovations, but just improving how we work as a management company so people are willing to sign longer leases and willing to pay a little bit more.
Definitely. And then point number 3 is the location. Chattanooga is a market we're already in. It's a market we've had success on an exit already. And, if it was up to Dave and I, we'd own dozens of properties there. It's just really hard to find them, being a little bit of a smaller market. But getting bigger, it's grown over 4% since 2019. And we put that stat in 6 months ago. So it could be over 5% at this point.
Yeah.
And I think a big driver of that is you see the stat, almost 7% job growth in 1 year alone last year.
Yeah, we'll look at the map. Some we've talked about it with Volkswagen and Amazon having 2 massive facilities here. And also our rental growth here on the apartment side. Chattanooga's had one of the highest rental growths of any of the markets that we currently operate in. We've talked about that in some of our quarterly updates if you've watched those, but the market as a whole has done very well for all real estate asset classes out of there.
Definitely. And then kind of harping on that sentiment, here at Midtown Office Park, bullet point 4, they've had incredible leasing momentum. Since March of last year, they've leased 80,000 square feet, and those leases have been signed at a 15% premium to what their average on the rent roll was. So, a lot of momentum and better, higher paying tenants. And then bullet point number 5, a catalyst for that might be, the building structure. It's COVID friendly. It's got surface street parking and plenty of it. And employees can park and walk right into their office space with individual exterior entrances. And then once they're in there and working, they have their own HVAC. So they're not breathing the air being recirculated from their neighbor.
Yeah, one thing we've been looking at a lot as we track foot traffic with cell phone data, and we purchased that, is all of our commercial space that is lower density, or really lower floors. Our foot traffic numbers are either at or above where they were during pre-COVID. But for buildings, and we're watching other buildings just to see how they're doing, the larger office towers that are, 15, 20, much higher than that, they're still at about 50 or 60% of pre-COVID foot traffic in the markets that we operate in. So those buildings are not fully back. That's kind of a question there, but these low-rise ones, they are. And they're doing great. And a lot of that activity is stuff that we've purchased in the past couple of months here because of that and that insight we have. And so we're excited about those. We like the building structure here. So we're very, very bullish on these 1- and 2-story buildings that are out there.
Absolutely. And that kind of caps off, the 5 points that we definitely want to hammer home today. And if you've joined webinars for Greenleaf in the past, the structure will be a little bit different today because we wanted to follow this kind of, sequential 1, 2, 3, 5, 4, 5 bullet points, and that's how we structured these slides to follow.
So we're going to talk a little bit about why we like this basis number, and these are some examples of other deals that have traded in the market. And keep in mind, we're buying 10 buildings with 42 tenants all in one purchase, whereas most of the exits that we see, this is one of the larger deals in the Chattanooga market of number of buildings and stuff together. So most of these other exits or sales comparables are fewer tenants or single tenants, right? And those, for those who are getting, the highest one on here is up to $200 a square foot. And that's a single story with some medical, not even all medical,
right? Just
some medical and nice. So that's where we see, we've mentioned our basis and that we like it, but these ones at the bottom here, 145, 170, 150 and 9, these are all highly occupied single story with some medical.
Right. So a good comp for some of our buildings now, and hopefully all of our buildings by the time we're ready to exit, if we were to exit as a portfolio 5 years from now, or whatever it would be.
So if we jump to the next one here, we can look at what are the value add opportunities we have. And this is an interesting proposition, knowing that we have a lot of buildings and they're all individual, and we can kind of do what we want with each one at a time. Here we have 3 main tenants. We have IRS building, we have Chattanooga Eye Institute, and we have the city of Chattanooga. So you've got state and local government, you've got a medical tenant, and you've got a federal tenant that are all in their own buildings. We're working on expanding the IRS lease that they have right now. But when we look at these 3 tenants compared to what other exits have occurred in the market, the values we see on these are much higher than $81 a square foot.
For sure. So this page highlights our second point. It's the value add strategy. And, typically and how we model this deal is we buy it, we fix it, we lease it, we hold it and sell it in year 5 as a portfolio. So probably kind of the base case conservative modeling. And here, looking at the buildings, looking at the tenants, the rent roll, these 3 opportunities jump out at you as being well worth more than we're under contract for. And so, day one, we could spin off this Chattanooga Eye Institute deal as a single tenant, long-term medical tenant that's doing, operations and, inpatient exams, for $1.5 million. You see here, nearly double what our basis is.
Yeah, so that's 150 a square foot we could exit at after an $81 acquisition. And we're not putting a lot of our value add we're talking about is the vacant space. We're not investing dollars into this physical building here. So,
right.
So that's a great opportunity. The city of Chattanooga one, if we were to exit that one based on a state and local lease at $180 a square foot. And then the last one,
and that value is really driven, the rents here at this building are much higher than the average in the portfolio. So the city of Chattanooga isn't the only tenant, but there's other medical tenants in there. And I'll point it out more when we talk about lease comp, but they're much higher than our average portfolio. And so this, just putting a conservative cap rate on that city of Chattanooga lease, that's worth a $5 million lease. So just that piece of the building is worth half the value.
So if we look at 3 of these combined, knowing we started with 10 buildings, we look at these 3. These 3 give us the opportunity really to sell out these 3 as individual assets to an individual buyer, and potentially we structured our debt on this deal that we are allowed to make prepayments on the debt, pro rata of whatever what we sold. So if we sell 1 building, we can pay off that pro rata debt amount. So we did all 3 of these, and we're able to execute that in the first 12 to 18 months. We could look at reducing our debt by about $6.5 million and making enough profit on these deals to return all of the initial equity. So that's our big value add. Now, this is a perfect scenario of we're able to exit all these 3 at the values we want, and then really have that big return of capital, almost like a refinance. How we've modeled the deal, though, is that we hold these, and that still hits all of our cash flow returns if we hold them going forward. So this is if you participate in other Greenleaf deals, it's like, hey, 2 years in, we have this refinance, we're able to pull all of our equity out. If we're able to do that here in this situation and hit these values, we'll execute that as well here.
Yeah. So it's just one of my favorite things about this deal. We keep hammering about the basis, which is great. We got a good deal on the property, but there's just so much flexibility with it. Being individually parceled, having some concentration of federal government, having some concentration of local government, and then having this increasing amount of medical tenants in there. As a whole, there's not a lot of buyers who are going to buy a $25 million portfolio. That's really a hodgepodge of things. There's this and there's that.
You got us.
So we will buy it. And that's why we got a deal on it. But then we can go in and execute the improvement strategy on the buildings that aren't as nice and aren't as occupied. But we can single out these other buildings that other groups will pay a lot for because it's right down the alley. It's specific to their criteria.
Yeah. Perfect. So lease comps, we've mentioned that some of the leases here or our average leases are below, but also a lot of the other leases in the market, no one's signed a 270,000 square foot lease right now. So all the other leases are smaller. And typically when you have smaller leases, you also have higher rents with those leases. So most of ours, as you see at the top here, are mid $12 range. And we have modified gross written next to it, meaning we are covering or reimbursing or going back and forth with the tenants on some of the expenses. A lot of these are triple net that are in the market. So that's almost even higher than what the numbers show here.
Sure.
Because
so
they're covering all their expenses.
1250 modified gross, looking at our expenses, that's probably more like $8 net. So when you put that apples to apples to what these other leases are being signed, it's paltry when you compare the two. And there's a background story for that. We've been working on this deal for a long time, so I know the history of it. And the person we're buying it from got the whole complex at a great discount, and then had some large tenants, and then one of his biggest tenants that he spent a lot of money building out their space left, and then COVID hit and vacancy, went up to 50%. So he almost lost the property. So there was this hurry up and just get bodies in the building so we don't lose this property. So, that 1250, there's some paying $8, and then there's some recent leases being signed that are high teens net, much more in line with what we're seeing at other properties. And so everything is kind of gradually moving more towards those higher teens, more net leases. And then we just need to take over the reins and fund those transactions to get it, more in line with where the market is.
And our confidence on that is a mix of, we're seeing the other deals in the market. We have our CoStar, which is basically a data aggregator of all leasing activity. And that shows this $17 to $22 per square foot rental range. But then we also have, we have a 112,000 square foot building in TVTC that we've been leasing in the mid 17s. That's also right in this market. And we have state and local there, and we have other individual tenants there in logistics. So knowing what the market's at, seeing we're at 1252, knowing we have some vacancy that we can go get higher rents in, that's why we like it on the lease comp side.
Right. And I don't think that it's a moonshot goal to match what these other properties are doing, because the current owner has done that. They've signed a half dozen leases that are in line with what the rest of these buildings are getting. On the other hand, they've also signed a dozen
older though. That's older.
very tenant friendly leases, just to kind of get people in the building.
Yeah. So just a quick recap, there's a lot going on this map right here, and we're going to zoom in a little bit more to just go into this specific property. But the star that's right in the center below where it says Carta, that's where this location is. And you can see further to the west, you get towards downtown Chattanooga, some of our assets over there. But then further to the east is where you're seeing the large scale employment centers that are not downtown. Those are the top right there. You've got Amazon and Volkswagen. And then literally, we put it on the map. It's like, you could probably throw a stone to it. The airport is right north of where this deal is. It's right there where it says Chattanooga Airport, CHA.
Right. And just like Midtown is right in the middle of the action of Chattanooga, Chattanooga is right in the middle of the action in the southeast. You see these highlighted markets. Nashville's 2 hours north, Huntsville's 2 hours west, Knoxville's 2 hours north in the other direction, and then Atlanta, where we are, 2 hours to the south. So it's just right in the middle. You can get everywhere. There's two major interstates that take you in either direction, and then Chattanooga downtown has had this incredible growth, but it's really restricted land-wise with the river to the north and to the west and mountains and highway to the south. So the really only natural place for the growth to happen is for it to push east closer to where Midtown is. And Midtown is just perfectly situated close to the airport. It's right next to a big mall development, redevelopment. And then the CARTA, that's the local transportation for Chattanooga, which is a big key for governments to move in. They want people to be able to get to them. They want, public transportation to their site. And then like Dave mentioned, the 7% growth in 2021 for jobs, we highlighted just two of them up there, Amazon and Volkswagen, which both just announced huge expansion. So they're probably going to double those numbers we have on the screen. Volkswagen is going to put in $1 billion facility to build their new electric cars there. And then Amazon, they're doubling about every couple of months.
Doing their thing.
They're doing it here too.
Yeah.
And then the largest employer in Chattanooga is Erlanger, which is the healthcare system, which has been ranked, one of the top healthcare systems in the Southeast. And the hospital less than 2 miles from Midtown is going through a $50 million renovation. So that little pocket there is where, all of the very high end, 200 plus a square foot medical assets trade. And we're not that far from there, and they're expanding. So, all good news in Chattanooga, all good news with Midtown to really go over.
So if we look at some key tenants that we have here, we've touched based on a few of them so far, but two of these are a city of Chattanooga that are making up over 30,000 square feet. Smile Brands, Smile Brands is a very, it's new in the medical space. They've been around a while, but they're aggregating dental practices and expanding rapidly. So they're taking small dental practices, turning it into like a national footprint within Smile Brands.
Let's get you a mom and pop, probably 2 dentist practice with no credit. And then now you bring them into the fold of a major aggregator national company, and you get their credit paying the lease.
We have some other deals with Aspen Dental. That's another very similar brand. They actually have the same colors. So maybe they're going to team up at some point. But the other ones down at the bottom here, we touch base on the IRS at almost 17,000 square feet, and the Chattanooga Eye Institute at just over 10,000 square feet, and then a medical clinic that we have in here too that's 10,000. So this is kind of a snapshot of what these key tenants look like that are here.
Sure. So, and another thing to point out, the city of Chattanooga in the top left, the Revitalist Clinic, all new leases that have been signed. And if you recognize their lease rate, you've got $19 and $18 net. Great leases, for large chunks of space. And that's really where this property is trending if you'll invest the money and renovate it and pay for those TI and leasing costs, which is what we plan to do.
Yep. All right, so here we're going to take a look at just what this asset looks like. We know there's a lot going on. We have a couple different things here on this aerial view here. The ones highlighted in green are all of the buildings that we're purchasing. The ones highlighted in yellow are the ones that the individual we're buying them from still owns, and he has future plans for a lot of those locations. You see one of them is a vacant parcel of dirt that he plans to put apartments on. The one north of that where it says townhomes, he's planning to build townhomes there. And you can see to the west, we have Eastgate Mall, and to the east, we have a big Walmart. And some of these other buildings that are in here, we made note that the post office is on the bottom the bottom side in the center there. And that's a big REIT.
This is a good proof of concept. The seller we're buying the property from pulled the post office out of his CMBS loan to be able to sell it, and ended up selling it to the largest REIT post office for, I think, around a 6 cap range. So we modeled a 7 cap exit for the 3 strategies we talked earlier. So he kind of dabbled in, that strategy of selling off the pieces being worth more than the whole complex.
Yeah. And you can see to the north, the property is bordered by I-24 on the bottom side here, which is a major highway that goes into Chattanooga. And on the north side, that road up there is just going right to the airport. So
It's
pretty
Brainerd
bound.
Road, a main thoroughfare, 30,000 cars a day. So, two major transportation hubs to the north and south of our
It's hard to
property.
get more traffic
Right.
than those two
Harder to
roads
have better accessibility.
in Atlanta, in Chattanooga there. So the 10 that we're buying here are highlighted in green. And we think about the 3 that we mentioned from an exit potential. The IRS, the city of Chattanooga, and Chattanooga Eye Institute. So this is where these 3 deals are located. And you can see they are basically full buildings that are there now that we would look at
Their own
selling
parking,
those.
individually parceled. So easy to spin them off and sell individually.
And if we execute that component of the strategy, that leaves us with 7 buildings that are now highlighted in green here, with the other yellow ones, still the other seller with his plans on his redevelopment efforts in those sites. But that would leave us with these 7 buildings and essentially no equity in the deal.
Right. And still having medical tenants, local government tenants. So still having kind of the backbone tenant base, which is why we
Yeah.
like the deal. And then the opportunity to just fill in the rest with more.
Yep. All right, so investment overview as a whole, we mentioned our total deal cost, up to 27 million. We're starting at 22 million, that $81 a square foot on the space. And that goes a lot through our capital improvements, our reserves that we need to hold. We're putting all that money into the deal up front. So day one, we'll have these. The thought is we have this money so we can go sign these leases and execute the lease up plan.
Right.
Right. And the reality is that lease up plan, it's a mix of us doing tenant improvements or us giving them these concession dollars or them doing the improvements that we fund. It's a pretty wide negotiation on how that happens. But that's why we want to make sure we have it all up front.
And we are really modeling based on our experience, in larger markets like Atlanta or Charlotte or Raleigh, Durham. Chattanooga is a little bit of a smaller market. These are a little bit less sophisticated tenants that might not have a leasing broker with them, and they might not even know what they could ask for from a tenant improvement perspective. So I think we're well equipped with a big arsenal, probably overly aggressive with how much money we'll need for this TI space to help build it out, which could spend less on others and then spend much more on medical office space to build it out, like these pictures you're seeing, where there's exam rooms and surgery.
Yeah, we've done some medical build outs that are upwards of $50 a square foot. But then we've done some general office that's like, you should get a couple dollars a square foot. So depending on the space and the tenant and what they're looking for, it varies significantly in that strategy. We are obviously aiming for the more medical and government tenants to go in here. So we're prepared to spend the larger dollars. That's the goal here. From a return structure, it's a 7% preferred return with a 70% profit sharing to the investors. And then on the right-hand side, again, the right-hand side model is kind of what year 1 is and what year 5 is, but year 5 is not assuming that we've exited those 3 assets we spoke about. This is, we do our full process and hold everything. We've got to pick one way to model it. So we picked that way of saying, hey, if the sale doesn't work and we can't exit, what does it look like if we hold everything for the 5-year time horizon? And that pegs us at about an annual cash return over 8% and a 15% total investment return.
And the one last thing I'll point out on this page, in the capital stack, we have about $8 million in equity to raise. I think we're just over 5 million at this point and launched the deal last Thursday. So a lot of investor appetite for this deal, and a lot of reasons you see why.
The debt that we're securing here is right at 4%. So,
which was 3.3 a month.
I know it was a little lower previously, and there's all the conversation on interest rates going up and inflation going up and what that's going to look like. But here we are trying to lock everything. We're getting a good, even at 4%, that's still a good rate in our opinion. We'd love 3.3. We'd love anything lower is better, but still at 4%. It's very good for our numbers, and we like locking that rate going forward, especially what's going on.
Right. So our rate jumped a little bit with everything going on in the world, but that month delay, got us a little bit higher leverage when our appraisal came back above where we're under contract. Yeah. So it was a give and take.
So this is our slide that just shows our overall cash flows. And then when we're thinking about an exit, what does that look like? we're doing a blended exit here. We're picking 7.5 as a cap rate, and we're buying it for less than that. We're buying it for a cap rate lower than that, but that's where that value add comes
At
in.
80% occupied, and the market in Chattanooga is nearly 95% occupied. So
Yeah.
buying it at a 6 cap, taking it to market occupancy, gets it much higher than that 7.5 cap.
And then exiting, we plan to exit at a 7.5. That pegs us at over 20% IRR.
With none of the strategy we talked about earlier.
Yeah, if we were to
Just
exit,
exiting as a portfolio.
if we exit early on those things, it's just going to improve the IRR and improve the cash returns throughout this time frame. So if we look at a typical $100,000 invested, you see what the cash flows look like going out year 1 all the way to the exit in year 5. And then we touch base on our cash on cash return here. That, I mean, it's definitely value add. So we're looking at leasing this space and then distributing the cash from that. So it starts out slow and ramps up as we lease out that space. But Nathan mentioned that earlier too. Going in right now, the deal covers everything as it is and can make cash distributions before we even get to doing the value add component. So that's just
Which lets Dave sleep easier at night,
that's a good one.
managing the cash and having enough to come in to cover everything.
Cool. All right, so that's it for our presentation. We'll turn it back over to Dominique, go through some critical dates here, and then we're going to look at some questions that we have on them.
Thank you, Dave and Nathan, and thank you to everyone who has submitted questions so far. We also want to remind you that you can continue to use the Q&A feature located at the bottom of your screen, and our team will be sure to answer those. So we will already go ahead and address the questions that have come in. So we have a couple of questions varying about kind of the park makeup and really kind of also talking about the individual exits versus a portfolio exit. One investor asks, how does the individual exits change the IRR and returns?
So if we
It
have
increases it.
Yeah, it increases them, but specifically how it increases them, if we are to exit a deal or exit one of these parcels early, meaning we sell it at the end of a year or 2 years, all that cash that's generated from that sale goes back as return of capital first to investors. So just like in a refinance, almost until we return all capital, there's not any profit sharing. So when we think about IRR is all about the timing of when money is distributed. So the sooner it's distributed, the higher the IRR. In this case, with the sales, it would improve the IRR in that investors would receive their money back faster, their initial equity investment back faster.
Perfect, thank you. We have a couple of general market questions, what Greenleaf is seeing in the market. One investor asks, what general interest rate assumptions are built into the pro forma value estimates? And what are your takes on the interest rate environment kind of as a whole?
Yeah, that's a good question. Our model, we're continually updating it as we're closing the deal. So we have our 4% interest rate pegged into the deal. When we assume an exit, we're not really assessing what the interest rates are going to look like in 5 years on exit. We're more assuming what's the exit cap rate going to look like, and where interest rates are going to be or what they look like. There's a lot that kind of goes into that thought. And on one standpoint, we're seeing interest rates are rising. The Fed has talked about that they're going to raise rates, but also when you look out in the world and see money that wants to flow to safety, that normally drives down, especially our treasury rates as a country. So we have a lot of inflow of treasury with people looking for security that might counter some of the interest rate growth. But I don't think we're going to go back to rates in the 2% anytime soon. But I thought they needed to rise for a long time. So I could be completely wrong on that. But those two factors are kind of pulling out where rates are right now. So we're sticking with our 4% because that's the going in model. And on the exit, we're really just looking at an exit cap rate.
Right. And two things I would add specifically to the Midtown deal is that in the modeling, we have expenses increasing every year, 2 to 3% increase based on the expense. And then, the second point, if you look at the rent roll, leases, classic leases signed in the past were full service, meaning landlord pays for all of the expenses and tenant just pays a lump sum for their rent. So in that scenario, all of the risk for rising expenses is on the landlord.
Yep.
But you look closer to more recent leases signed, some of them are triple net. all of them have at least some kind of expense reimbursement from the tenant or expenses being paid directly by the tenant. So that's a nice little inflation hedge, and we'll continue that trend and start to turn over some of the older, riskier expense risk on us leases and move more towards triple net or at least some kind of reimbursement from the tenants.
And that's really operational value of saying, like, how do we negotiate these leases to make sure that they are positioning our investment returns the best? And that's a lot of that moving away from fully modify where we're paying everything to sharing it and pushing it out.
Sure. Like the city lease, 20,000+ square feet. And if utility prices double, that's all on the tenant. It's in their name. They're paying for that. And Greenleaf still gets the same amount of rent they would should utilities drop in price. So it's a good inflation hedge.
Right. Thank you so much. We have a couple of questions regarding the capital improvements and renovations. One investor asks, does the capital raise include reserves and capital improvements?
Yes, it does include the reserves that we need. We're starting with about $1 million in reserves out of the gates. And then we're going to add to that every year going forward. So that's in there from day one. And then also we are raising the funds that are needed for the capital improvements. And those capital improvements, some of them are aesthetic to the buildings themselves, but a large chunk of that is tenant improvement related and dependent on lease sign.
Sure.
So we have all that money up front.
Yep. About a third of it is for leasing costs, TI to build out the space, attract the tenants. And then there's probably a third of it, set aside for these buildings are older. There's some roofs that need replacing. There's some HVACs that need replacing. Those are the two biggest costs for sure. And then, probably a third of it to improve the aesthetic look of the park and make it a little more cohesive.
Thank you. Kind of speaking into more detail about that, while Greenleaf conducts those renovations, do you intend to relocate these tenants as these renovations are undergoing?
No, they're not necessarily renovations that require relocation of a tenant. If we replace a roof or we replace a mechanical system, we're able to do that with the tenant there. We don't have to move them around. So no, we don't plan to move any tenants.
We don't have the intention of doing it, but one very savvy thing the previous owner instilled in his leases is that the tenant, it's in their lease that if the landlord comes to them to relocate them, then that's just what's going to happen. So he's done a little bit of shifting around with the tenants to kind of make room for these larger tenants they've signed. And in one of the buildings he's owning now that he's thinking about converting, there's a 20,000 square foot tenant that wants to stay in the park, and he's just going to hand them over to us whenever their lease runs out. And so we have the opportunity. We've got about 12,000 square feet contiguous available for them. And with those lease structure, we could move tenants left or right of them to be able to accommodate, that large tenant that we're kind of getting handed.
Perfect. Thank you. We have a couple of questions wanting to clarify the makeup of the park. Can you tell us a little bit more about the owner? Is it all owned by one owner? I know we also discussed square footage of the offices, number of mid-rise buildings, things of that nature.
Yeah, I'll take this one. The owner currently is Urban Story Venture. They're a prominent developer in Chattanooga, and they have 3 major developments they've done in Chattanooga. One of them is a decade-long $1 billion redevelopment of the riverfront next to our TVTC building. So we're happy to give him money for this deal for him to go focus on that one and improve the TVTC. But he's one of the best real estate people in Chattanooga. He scooped up the whole park, from someone who was going to lose it, years ago. So he got it at a really good deal. He's improved it. And initially we were under contract for the whole property, which is our 10 single-story buildings, and then his 3 mid-rises. And we couldn't get connected on valuation because he put a higher price on these mid-rise buildings, whereas we actually had a higher value on the single story. So then we ended up just piecing off those 3, and then he decided to keep them, and then we bought the single story. Yeah, so all one owner, and then every building is individually parceled. So we're buying it as a whole, but no problem splitting them off. Yeah.
Thank you. We have a couple questions regarding the tenant makeup. We can start kind of off with this general question involving government office leases. Do they typically include a cancellation clause? What have you seen in your experience?
Nearly every government lease that we come across, they've got some outs. A lot of times it's if they lose funding. So, if the IRS loses funding, they could move out, which is kind of the opposite of the political
And
environment
that's,
right
yeah,
now.
and that's in every,
That's just I've
Every
almost
federal
never
lease.
seen a lease that doesn't have that out, that if that agency loses appropriations, that they can get out of their lease.
Right.
but
And are
right-
we worried about that at all?
for the IRS specifically right now, the IRS is just behind. They don't have enough people.
They're trying to double the workforce at the IRS, and we only need them to increase 50%
We
to
only
take
need
the
a
whole
little.
building. So
Yeah.
we got a good buffer there.
Yeah, I think the IRS is, I think it's well known that they're having growth struggles right now, and they need to hire a lot of people and expand, and they're working on that. And they've been given the money federally to do that, but given the money and executing that are two different things. So I know they're working on that, but the state and local, we haven't seen anything on them scaling back.
They're very sticky tenants, and they're our largest tenant at TVTC. So we've built a great relationship with them. And so, the public may get the official statement, and then behind the scenes, we get a more candid response, which is usually a little bit more helpful.
Are all of the single story, we've talked about there's the demand for these lower rise buildings that are out there, all of our medical, going back from March of 2020 until now, across all of our office, we've signed about 35 total leases in this low rise stuff. And that ranges from 400 square feet to 5,000 square feet. So all smaller stuff, but in this type of demand.
Sure. And if you think about it personally, if you're going to the dentist, do you want to go up an elevator to the fourth floor? Or
just wanna
if
walk
you're in
right
a
in.
wheelchair, do you want to go up to the fourth floor, or do you want to park and then just go right into the building?
Right. Kind of sticking with the current tenant makeup. We did talk about our government. Specifically, one investor asks about the city of Chattanooga's lease. Specifically expiring this month. What is the status of that? Re-up lease and duration, rate, things like that.
So that's the library that he's referencing, the 10,000 square foot. That's the city of Chattanooga's library. They've
Right.
been there for 30 years or something like that. Their lease is expiring, and current owner was handling the negotiations for renewal. The city came to them to renew. They want to be there. And when we saw their terms, we said, well, why don't you guys wait and let us handle the negotiation? The other city lease just signed at $19 net, and I think the library is paying like seven net. So I think there's a conversation to be had that we'll put money in to fix up the library in form of TI dollars, but they need to come closer to market rent. I think it's unreasonable to push them to high teens, but more like $10, $11, $12 net, would make much more sense. So that's in the works, and something that I think will be pretty imminent once we close.
Right. Thank you for that clarification. Let's talk about the Chattanooga market as a whole. Can you restate the office occupancy in the submarket? And then specifically for our park, are these considered Class C?
Sure. Chattanooga as a whole is mid-90s occupied. Downtown is even above 95% occupied. And our specific submarket in CoStar has them about 92, 93% occupied. And what was the last part of the question?
Class
C class.
Mhm.
Oh,
Right.
I see, yeah.
CoStar doesn't use the ABC. They do 1 through 5. And they categorize these low-rise buildings as kind of a two-star property. And it's more like resorts. A 5-star doesn't mean it's the best. It just has to have 2 restaurants, at the resort
Right.
to be considered 5-star. So
Yeah.
if this was the nicest single-story building, brand new built, CoStar wouldn't group it as a 5 because that's reserved for, Class A, higher rise.
And we're not
buildings.
typically buying anything that's Class A.
Mhm.
That's not really on our radar of stuff that's out there. So we like to look at, if you're saying it's Class C, there's not a lot of value add Class A out there, so to speak.
Right.
So sure, yes, it's definitely like a Class C type asset where we are adding value to it and improving lots of things, like roofs and any deal that has aged roofs that you need to replace or mechanical systems that aren't working right, you need to replace them. that's what we like to see. We want to find those opportunities, and that's more of a Class C asset.
Yeah, and like Dave mentioned, these Class A high-rise buildings, people aren't back to foot traffic wise, and you're
Yeah.
not seeing the leasing demand there that you are seeing for the single story, C-class properties. I feel like it's a negative term, but
But it's
they're
where
the
we-
ones that are doing well
It's
right
where
now.
we want to be, though.
Sure.
Right, exactly. Another investor asks, what is the submarket vacancy rate for office in this market?
It's kind of the opposite of the occupancy rate. So right now it's about 7% in this submarket. The other thing to think about when you look at occupancy and vacancy is what the new supply looks like that's going in. So it's one thing to say, hey, Chattanooga is 93% occupied. We're buying 270,000 square feet and they're building 4 million square feet down the road. That's a concern. They're not doing that here because
There's zero construction of
there's-
this product type.
there's
in the submarket.
of the single story office, there's nothing that's being added.
Right. And there's absorption happening, positive absorption every year.
So that's really what puts us, when we look at a supply and demand curve, when we see no real supply being added, but we have demand increasing for this type of space. That's where we want to be.
Thank you. We have a couple of questions regarding Greenleaf and really our fee structure as well as property management. Can you remind our investors on this call the acquisition fee, who is the property manager for the Midtown Park, and is there a GP catch-up on the 7% pref?
So acquisition fee, we have an acquisition fee of 2%. That's at closing when we close the deal. And then going forwards, our in-house management team, we've always led with our operational components of executing one of these turnaround deals. So our team will do the management of it, but typically they're also going to engage with external leasing brokers, especially someone like the city of Chattanooga or the IRS. Like,
Good to have a specialty there.
yeah, there's going to be outside brokers that are not Greenleaf tied to that transaction. And then typically if it's under 5,000 square feet, we are able to handle that internally. And many of those tenants do not have a external broker. So that's a mix of that, whether we're managing it, but the outside broker relationships vary. On the GP catch-up, I think what you're asking, like how our structure works is all of the capital is returned to an investor. When we have the 7% pref, it's only if money is distributed above that 7% in a year is it split between the GP and the LP. So if we distribute 10% in a year, 7% would be the preferred return to the LPs. And then we take that 3% that's left and split that 70-30, 70% to the LP, 30% to the GP.
Perfect, thank you. You mentioned a 3.99 or 4% interest rate. Who is the lender, and is this fixed or variable?
Wells Fargo, and it's fixed for 6 years at up to 75% leverage based on kind of appraised value
Right.
of the property.
And the second part of that question is, how will selling the buildings individually affect this loan?
So we've worked that into the loan with Wells Fargo that we can prepay pieces of the loan. It will not change. It doesn't change the interest rate. It would obviously change our payments and total loan balance and that kind of stuff. But our rate stays the same for the 6 years.
Wonderful. You mentioned the portion of the aerial view, the post office. Can you tell us a little bit more about that? The map showed that this deal, the post office was half highlighted. Can you speak a little more to that?
Oh, yes.
There's been an internal discussion. Is this 10 buildings? Is this 11 buildings? Is it 12 buildings? And it's one building specifically, the post office is split in half, and we're buying the left side of the building and the post office is on the right side of the building. So it's individually parceled.
So they have a joint wall.
They have a
but it's
joint
individually
wall,
parceled.
but it's individually parceled. And then it's almost touching the building next to it. So at times we count that as one. It's probably technically two. So it's,
Yeah, but it's like 2 feet away. So you can shimmy back through there, but
yeah. So the 2 years I was working on this deal, maybe 2 months was figuring out what we're actually buying and where all the lines are. And we actually informed the seller of some things that he didn't know. So, yeah, that's credit to our transaction team, digging in deep, doing all the title work, doing the survey, figuring out what we're actually buying, how many parking spaces we have, doing all of our due diligence.
Perfect. We have another Greenleaf market, really investment and buy philosophy strategy question. What is Greenleaf's stance on commercial property values in the 5-year exit horizon, given the potential rapid rate increases and inflation?
there's a lot that goes into that question. But if you think of the commercial properties that we're involved in, we're very bullish on. The lower rise, easy in and out, surface parking, those commercial assets we're very bullish on. We're definitely very bullish on government, state and local, all medical. Those types of facilities over the past few years have performed very well, and the demand for them continues to grow. So we like that component of executing the commercial real estate operation with those three. When we look at the impacts that rising interest rates or inflation will have on two factors. One is property values. The other is operations of a piece of real estate. And if we start with inflation, as that drives up costs, and we see, everyone's seen gas prices have just gone up, right? But as you see utility costs go up and you see all these costs that are increasing, that's where we're working on converting our leases to more of a tenant cost versus a landlord cost. Now, on that front, a tenant only can do so much. They only have so many dollars that they're willing to pay towards rent. And whether it's rent or utilities or whatever to occupy a space, there's only so much they can pay. And we didn't talk about it a whole lot on this, but on the roofs of all these buildings, and we're looking at it on a lot of our other commercial space too, we have solar panels that are helping to reduce the cost of utilities across the board. And we'll look to expand that here as well. And we've just installed systems on some of our other buildings as well to help reduce that utility cost, because tenants can only spend so much. It's not that, utility costs can go up 10x and they're like, oh, we'll just keep paying all the same and pay for more of that. That's not going to happen. That has to work together to make sure that we do manage those expenses. We do everything from low flow. We've always done that stuff to try and make it as energy efficient as possible. On the interest rate side, I think there's two conflicting things, which is one, the Fed wanting to raise rates. They've talked about that. They've already kind of primed us for being prepared for that. But then also this influx of where is a safe spot to put your money that will also then drive down rates as well. Now, the market's not driving down what the Fed sets as interest rate. It doesn't work that way. But there is the aspect of they do impact one another and they are looked at. So overall, commercial real estate values, there are certainly things that are going to struggle in the coming future. We think that's mostly high-rise buildings. Those are typically also house more individuals that have a much more flexible work schedule. It's hard for a dentist to do that remotely. So they kind of have to go in the current world, at least. So we're looking at those roles where people have to go to these spaces to be there. And we think that commercial real estate is where we want to put money. We do not want to be putting funds into spaces that have not excessive, but ample flexibility in whether they're coming to the work or not.
Right.
Perfect. Thank you so much, Dave and Nathan. We are approaching our scheduled time for this live stream. If you do have any other questions, please don't hesitate to reach out. Any submitted questions that we did not have time to answer, I will be sure to reach out with you directly and get those questions answered. All right, with that being said, this does conclude our regularly scheduled program for the Midtown office opportunity. We'd like to thank each and every one of you for joining. Again, if you have any investment interest, please do not hesitate to reach out directly to myself or one of our team members, and we're happy to confirm you an investment position. I'm going to go ahead and share my screen with these upcoming dates for the Midtown opportunity. And with that being said, we thank you so much for joining. And if you have any other questions, please don't hesitate to reach out. Thanks again and have a great day.
All right. Thanks, everyone.